If you're running a business in the UK and you're trying to decide whether it's better to stay as a sole trader or switch to a limited company, you're definitely not alone. This is one of the most common questions we get asked, and it's also one of the easiest ways to accidentally donate a few extra £1,000 a year to HMRC, which I'm guessing isn't at the top of anyone's wish list. My name is Jack Rivas, and today we're talking about the advantages and disadvantages of being a sole trader versus running a limited company. And now is a really good time to review this because, surprise, surprise, the rules are changing again. We've got Making Tax Digital for income tax starting to come in from April, and dividend tax rates are increasing by 2%. So if you're still making this decision based on advice from a few years ago, there's a very good chance it's already out of date. As a sole trader, you and the business are basically one and the same for tax purposes. All of your profits are treated as your personal income, which means that you pay income tax and national insurance on them. This is assessed each year via your tax return. There's very little flexibility to this, as once the profit is made, it's taxable, whether you take the money out the business account or not. A limited company works very differently. The company is a separate legal entity. It pays corporation tax on its profits, and then you decide how and when to take money out, usually through a combination of salary and dividends. That separation is where most of the planning and potential tax savings come from. Now let's talk about tax, because let's be honest, this is usually the deciding factor. As a sole trader in 2026, your profits are still taxed using the income tax bands. As your profit grows, more of your income gets pushed into higher tax rates, and when you add national insurance on top, the overall tax bill can start to feel pretty painful. On top of that, Making Tax Digital for income tax is coming in from April, which means many sole traders will soon need to submit quarterly updates to HMRC plus an end of year submission, rather than just one tax return a year. So the simplicity that used to come with being a sole trader is starting to disappear. With a limited company, the tax picture is more layered, but also more flexible. The company pays corporation tax first. Then when you take money out, you might take a small salary and the rest as dividends. Dividend tax is increasing by 2%, which has understandably made a lot of people nervous, but it's important to keep this in perspective. Even after the increase, dividend tax rates are still lower than the equivalent income tax bands. So while dividends aren't as attractive as they once were, they're still usually more tax efficient than taking everything as salary or being taxed entirely as a sole trader at higher rates. In most cases, at lower profit levels, being a sole trader is still cheaper and simpler. There's less admin, fewer filings for now, and lower accountancy costs. But as profits increase, limited companies often start to win. Not because corporation tax is magically low, but because you have more control. You can decide how much to take out personally, when to take it, and whether to leave profits in the company for future growth. Let's do some numbers so it's not all so abstract. Say you make £50,000 of profit in the year. As a sole trader in 2026, you'd have to pay roughly £9,700 in income tax and national insurance. That leaves you with around £40,300 to play with. Now let's look at the same profit as a limited company. If the company makes £50,000 and you take £12,570 as a salary to use up your tax-free personal allowance and took the rest as dividends, you'd pay around £7,100 in corporation tax and roughly £3,200 in personal tax. leaving you with about £39,700. So at this level, you'd end up slightly worse off as a limited company. However, as profits increase, limited companies become more favourable, because here is where the planning comes in. Say you make £100,000 in profit. If you stick to a small salary and take around £35,000 as dividends, you'd pay roughly £23,100 in total tax. As a sole trader with the same profit, you'd be looking at around £30,700 to pay in tax. That difference exists because company profits aren't pushed into higher tax bands in the same way personal income is, and because you get to choose when to take money out and when to leave it in the business. That control over timing can make a huge difference to your personal tax bill. There's also risk. As a sole trader, your personal assets are on the line if something goes wrong. With a limited company, your personal assets are usually protected. There's also credibility with a limited company, and you'll find that some clients and contractors prefer working with limited companies as it seems more official. On the flip side, you can't just take money out whenever you feel like it. There has to be profit available, not just cash in the bank. And while we used to say that limited companies come with more admin, but thanks to MTD, this might not necessarily be the case anymore. One thing we see all the time on this topic is people making decisions based on half information. Some people incorporate far too early and end up paying more in accounting fees than they save in tax. Others stay as sole traders for years longer than they should and quietly overpay HMRC thousands of pounds. And I think it's safe to assume that a lot of people will now be caught out by making tax digital by assuming it won't apply to them, only to realise too late that it does. The honest answer is that there is no single correct choice. It depends on how much profit you make, how much money you need personally, how much risk you're exposed to, and what your long-term plans are. I've seen sole traders paying less tax than limited companies, and I've seen limited companies saving huge amounts compared to sole traders, all in the same tax year. If there's one takeaway from this video, it's this. Don't make this decision based on outdated advice or something you saw online. With MTD for income tax coming in and dividend tax increasing, the numbers matter more than ever. Speak to an accountant before you make any changes so you're not stuck overpaying tax because of a poorly informed decision. If you found this useful, make sure you like and subscribe for our weekly tax updates and more videos like this. See you next time.